We're live, everybody. Thanks for joining us. I see panelists starting to come in. I'm sorry, attendees starting to come in as well. Looks like our panel is finding their way here. If you can't start your video or something, let me know. I'll get it started for you. There, we're rocking and rolling.
All right.
Dan, we got Dan, our moderator. There he is. There he is.
Morning.
How are you?
I'm good. Afternoon, I guess it is, huh?
I know this has been a bit of a grind. If you've been with us since Dr. Dotzer at 8 a.m.
Yeah.
There's a lot of information. I've got a notebook full. So I'm going to let you all take the industrial panel. I'll be here in the background. If you need anything, holler at me. Good luck. Take it away, Dan.
All right, great. Thanks. Thanks everybody for participating this morning. I want to make sure that each of the have a chance to introduce themselves. I'll start. I'm Dan Cauley. I'm the president and founder of Cawley Chicago Real Estate. We're a boutique real estate company with offices in Oak Brook Terrace and in the city of Chicago at Halsted and Chicago Avenue. We're focused on industrial and office and medical properties from a leasing and management standpoint. We manage about 7 million square feet of property as well. And we're excited about what's going on. So with that, let's just, if you don't mind, we'll just kind of go around. Dan Barrins, if you don't mind, you can give us your bio, your intro.
Sure. My name is Dan Barrins. I'm a senior VP at Associated Bank. I've been at Associated for about 7 years now, a little over 7 years. Commercial lender for about 18 or so. Associated Bank's the $35 billion bank headquartered in Green Bay, Wisconsin. We have lending offices in 8 states. Our main focus, our main area we lend to, our geographic region would be what I like to call our traditional Big Ten states around the Midwest plus Texas. I'd say over the last probably handful of years, probably 90 to 95% of our business has been construction, with the remainder being term debt. We like construction, and that's kind of our bread and butter sweet spot.
Great. I just want to remind everybody, make sure that we can hear you. So lean into your speaker, please, or into your microphone. Alfredo, would you like to go next, please?
Good afternoon, everybody. My name is Alfredo Gutierrez. I'm the founder of SparrowHawk. We're based in Houston, Texas. I've been an active industrial real estate merchant investor for over 30 years. I founded SparrowHawk over 10 years ago on this principle. SparrowHawk is a company dedicated to strategic industrial real estate investing throughout the United States. As a merchant investor, SparrowHawk operates as an entrepreneurial firm with access to institutional funds. We are a streamlined company by design to preserve a nimble, hands-on investment approach. I'm directly involved in every transaction and foster a long-standing relationship with investors, owners, and brokers. Because we are free from institutional restraints, the company can explore leading-edge strategies and offer innovative financing solutions with speed and creativity. SparrowHawk owns and operates industrial buildings currently throughout the Midwest, including Chicago. I thank Real Estate News for putting this 19th annual forecast together virtually. I look forward to the 20th being in person, and I appreciate being a small part of it.
Thanks. Josh, how about you?
Josh Hearne. I'm a principal at Cauley. Dan, you already gave the background on the company. So myself personally, I focus on industrial brokerage. I've been doing it for about 16 years now. And I think we're in for a good ride here in 2021, and look forward to getting into some of the topics here today.
Morning, Tom. You look really good today, Tom.
Thank you, Dan. Well, good morning to everybody out there in virtual land. Tom Boyle, I'm a principal here with Lean Associates. I am the past president of the Chicago chapter of SIOR, and I am also the past president of the Association of Industrial Real Estate Brokers. People ask me what I do for a living. I tell them basically I do 2 things. I relocate companies from Illinois to Wisconsin, and I convert farms into industrial parks. It's like
Matt, how about you?
Well, as luck would have it, similar to Tom, I relocate industrial businesses from Illinois and bring them to Indiana. That's what I do. Yeah. So we got Illinois covered. No, MCR Partners is a professional service firm that we have links and partnerships directly with Bradley Real Estate, who's a Midwest firm, and HWC Engineering. So what we do is bring together both municipalities and site selectors, along with real-time ownership of real estate, and really package deals together. We bring in our friends from the governmental agencies and talk about incentives and finance and planning, and help our clients through everything from entitlements to general beefs with landowners. So we try and take a pretty comprehensive approach. But it's done in partnership with a lot of professionals that are on this call. I myself am a commercial broker, along with an economic development professional. So, we lean in to work it. So I'm glad to be on the panel, and thanks again for the invite, and looking forward to our discussion.
Well, thanks to everybody for being here. We've got a number of questions that we want to run through here. I'm going to start with what was the single, so we've heard a lot, I don't know, we've heard a lot today, I think mostly positive feedback and opinion about what's going to happen in 2021. I think going through 2020 was a first time for everybody, right? And so we're all just trying to feel our way through this. And hopefully it's provided us some education as to how to handle this going forward. So the first question I'd like to ask the panel, and whoever wants to jump in, jump in. What was the single best idea or result you discovered as a result of the shutdown in 2020?
So I'll take a run at that, Dan. When the pandemic hit, the economy shifted. And so, having been in the business for a while, I realized that when the economy shifts, there are losers and there are winners. So the trick was try and figure out who will be the winners. And it took a couple months to manifest, but, ultimately, I figured out, and this is really no revelation, but I figured out that any company that, distributed, trucked, was a logistics provider, a packager, or a manufacturer for any product that went to a grocery store, a CVS, or a Walgreens was a winner. Now, I had a couple of existing clients that are in those markets, and they became very busy. As the rest of the world was shutting down, they were opening up third shifts. So, that was probably, the most important result for me.
Great. Anyone else?
I would follow up right on what Tom just said, and kind of reiterate a little bit of what he just indicated. We pride ourselves on knowing our tenants. As we acquire industrial buildings, we immediately get to know them, from day one, from due diligence. And, that was important during the pandemic. As companies were shut down, some of the tenants, depending on what business they're in, as Tom indicated, if you're CBS or supplied, support to Amazon, you were doing fine. But if you're providing support to hospitality or to entertainment, those tenants of ours were shut down. So we knew their business, we knew who they were. It was nice to call them and have a very honest and frank conversation with them and figure out quickly what are we going to do together as a team in order to get on the other side of this pandemic. The other thing that I did start to notice, and it's interesting to see on this panel alone, is that these secondary cities and Wisconsin, Indiana, branching out to these other cities throughout the Midwest, really prospered tremendously from the branching out of the 3PLs and as a result of COVID and getting it out to the population. So it was nice to see the I'm not going to say birth, but the growth of the secondary and even the tertiary markets during this time. So those are the two things that we had our hand on those polls, and it was nice to see them come to fruition, having our hands there.
So Alfredo, I think most of the brokers on the panel here have heard numbers about what percentage of tenants were paying rent. And it differed, obviously, based on a product type. Industrial seemed to be pretty steady. Could you summarize 2020's rent payments for your portfolio last year?
You know, really, it was quite interesting. You know, the tenants that we, you know, immediately, that was the first call made is talk with property management and say, look, guys, we gotta start getting a hold of our tenants and figure out what they're doing. And,
Right.
and you know, collectively, including everybody, my staff here and our property management teams did a phenomenal job of doing that. And so interesting enough, the tenants that we were able to get a hold of within 24, 48 hours, they're still tenants. The tenants that I couldn't get that conversation with, and you know, weeks would turn into to a month. Those tenants have not made it. So I've seen more bankruptcy in our portfolio in 2020 versus 2008 or even 2000.
Oh,
So there's quite a bit more, but collections existed out of our base of tenants. We probably lost 5 or 6% of the tenants. Traditionally, all the smaller end of the tenants, and they were specifically regional distribution guys that were supporting the restaurant business and the hospitality business, and their business just dried up, and they didn't have the staying power. They didn't have the guarantors, the corporations behind them to keep them alive. So those guys they went out of business, which you hate to see happen.
yeah.
The advantage I'm seeing today, though, in the last 60 to 90 days, is I've seen a lot of traction in that area, which goes back to what was said earlier on the call with the economists, that companies are coming out of the ground, they're starting new businesses, and that's encouraging to me from an economic standpoint, that new businesses are coming back, and they are leasing space, and it is the smaller space. So you're starting to see some of the benefits from some of the negativity. As far as collection, to answer your question, taking out that group that I just mentioned, another 5%. We had to do some sort of deferment program, meaning, look, we're going to give you a base rent abatement for 3 months, but we want you to pay it back over the next 6 months. And every one of those tenants did it. And every tenant now today has paid back any deferment that they incurred during the pandemic, and everybody's current, and we're not chasing anybody. So there's some positive signs there. We just had to live through the pain.
Dan, from your perspective at Associated, any foreclosure, what's happening there with your portfolio?
No, I mean, we've been able to work pretty well with a lot of our clients, our developers and their tenants. Similar to Alfredo, we were trying to be as generous and humane, I guess, as possible with, all of the issues that were going on in the market. So a lot of our tenants, or a lot of our landlords, were telling us, hey, look, we're giving these 60, 90, 120 day deferrals to our tenants. So we would try to accommodate that as much as possible. We did the same thing. We would, kick out payments, defer in most cases, just principal, but sometimes principal and interest, and let the developers get on the other end of this. I think we did a pretty good job. There haven't been a lot of foreclosures. Actually, I don't think we've had any foreclosures. And we have a pretty diverse base of real estate in our portfolio. Like I said earlier, the majority of our stuff is construction, so we didn't have a lot of that as it relates to industrial. Most of our industrial is pretty quick life cycle. It's built and it gets sold or stabilized and refinanced out. But I'd say that was the majority of our portfolio was retail, that we had to really work with our borrowers to do what we could to keep them alive and keep their tenants alive.
So on the lending aspect of this whole, of the construction of the development and the construction, so the villages were shutting down or going to skeleton crews. Did you see a slowdown there? Because I think
Absolutely. I mean, I wouldn't even say that just in the villages. I say even the city of Chicago. I have deals on the West Coast. LA County was really slow, so it's been a very difficult process dealing with municipalities. Hopefully, come spring, maybe summer of 21, that'll start to change. But it really was a difficult task to really work with municipalities to really get projects off the ground. I mean, just specifically in the city, the zoning board, ZBA, and all those meetings got pushed back, and it was just a slow process to get anything taken care of in the city, and really mostly in our footprint. It's been a really difficult situation to try and really forecast when a deal is going to start, or when construction is going to start and when it's going to wrap up. Obviously, when we look at construction in Chicago, particularly the Midwest, we have a construction season, and if we miss that construction season, no one wants to break ground in the middle of December. So that really complicates matters, and we've done a lot of modifications to make sure that developers can build what they need to build and hopefully stabilize and roll it out.
I'd like to get that. Thanks, Dan. I think you made some really good points there. I'd like to get some of the other panels input on that from a construction standpoint. Are you seeing that? I think we all agree that the deliveries were reasonable based on what the economy was and what the situation was, right? Are you seeing that improve? Are we getting shorter delivery times?
Yeah,
I mean,
this is.
I'll jump in for a second. I mean, to some degree, Dan, it's interesting, Dan Barrins, that is, it's interesting, in the city, you talk about slowdowns and everything, most of my business is suburban. And so I've noticed actually almost the reverse. If the municipality is proactive on the project and would like to see it happen, most of these municipalities have gone to virtual meetings and town halls and everything. And what happens then is you get a lot less chatter from the community because of it. They don't necessarily even allow the input of the community, almost similar to the panel that we're on right now. The audience can't sit there and, voice their opinion right off the gate. So it's, the municipality, if they want it, they're going to push it through, and they can actually push it through sometimes faster than what has historically happened. I've witnessed, again, Dan, going on your banking side of things, I've witnessed some of the diligence timelines taking a little bit longer and approvals taking longer, but ultimately, the physical, there's been a couple other panels up here where they talk about construction, and I know Molly McShane referenced that all of their teams are still out and operating safely and just making sure that their teams, coordinate schedules and distance themselves. But, listen, construction has still gone on, and, there was a fair amount of new development in 2020. And I think you're going to continue to see a wave of development in 2021, primarily because absorption outpaced the development in 2020 in Chicagoland.
Matt, did you have something you wanted to add?
Yeah, just to add to that, I would say that there were, both sides of that equation. You had some jurisdictions that were prepared to operate and were able to get into virtual mode. And then there were ones, there were others that, quite honestly, whether virtual or otherwise, could be problematic to get a transaction through from the entitlement standpoint. So I think those communities that were prepared prior really succeeded and exceeded my expectations. Along with that, there were also businesses that were prepared to be flexible, that utilized, when necessary, the incentive opportunities the federal government was offering. I mean, it was unprecedented that a lot of the businesses that I saw would bother to do this. But the ones that were paying attention and had great relationships with their lenders and investors were able to get by that pretty quickly. And just like Josh had pointed out, I saw a lot of success in 2020. Surprisingly, they were projects that were currently in the pipeline or being discussed. And because all the subterfuge got cleared out of the way, so to speak, as a result of COVID, the projects that were meritorious moved ahead. And for quite frankly, in my submarket here in Northwest Indiana and the 7 counties, I'm pretty well out of inventory for most things. And that leads into the discussion of who builds what next, where, how does it work, and where do these investors come in?
Right. You had something you want to say there, Tom?
Well, I was just going to say, as you look at, construction in 2021, commodity prices have risen dramatically so far. I mean, steel has doubled since August. Lumber has quadrupled since March. Oil has gone from $14 a barrel to $51 a barrel. And then you've got lead times. Dock equipment used to take 3 weeks, now 6 months. So, the supply chain constipation is going to carry through to 2021. That does not bode well. And then when you look at the disparity between new construction pricing and existing buildings, that delta is significant. So it's going to take a lot more ante for people to, consider speculative construction in 2021, especially when you get under 200,000 feet.
Tom, to add to that, it's interesting that you talk about some of these construction prices. 2 years ago, we were talking about office build out being, $70 to $80 a square foot, and everyone thought that was expensive. I had one recently, a little over 3,000 square feet of office, and they came back and told us 140 to 150 bucks a foot.
Whoa. Well, all the GCs are busy. I mean, what I'm hearing is they're not really looking for new work because they're already at capacity. So that just means it's going to get costlier.
The thing on my side too is, as we're starting new projects, we're confirming with our developers, our borrowers, hey, we want to see you. We want to see your supply chain. We want to see that your supply chain, is not going to have a 6-month disruption. We're not going to be, waiting for steel or lumber or anything else to be imported from a different country. So, we're digging deeper on the front end to make sure that the supply chain issues aren't going to affect and slow down our projects too. I mean, it's wild that it's going to, it touches all of our worlds.
So that's a whole new series of questions that you're using to qualify lending, Dan, right?
Yeah, absolutely. So, I'm calling it kind of our enhanced due diligence. We're doing a lot more front end work, a lot more, a lot more probing questions on the front end of a deal than we did at the beginning of 21 or any time prior in 2019. I mean, last year alone, I sat in on I don't know how many, pencil drawings, for the construction projects, just making sure everything's on time, reviewing construction schedules, staying very involved with the developments to make sure that there aren't slowdowns, there aren't cost overruns that we're looking at. No one wants to look down the barrel of a huge cost overrun, based on timing, and that's something that the bank has stressed that we want to be on the front end to make sure we're avoiding that if at all possible.
So have any of the panelists, if you could speak to, is there a geographic movement? Is it moving from the city to the suburbs? Is it the suburbs to the city? Is it Illinois to Wisconsin? Is it Illinois to Indiana? What are you seeing?
Matt, I saw your fist pump there. Generically speaking, I would just say that a lot of it's going to high density areas. I think that's a good generic answer. And there's a couple different reasons. I think you're seeing, even, pre-COVID, kind of running into COVID, you saw, manufacturing kind of coming back to the United States. So you saw, businesses locating where there was labor, blue collar labor force surrounding the buildings. Then we talk about e-commerce. Tom, you brought it up earlier. Anything in e-commerce or grocery store, anything that was, a retailer that historically would have shipped to, a retail location and the consumer went in and picked it up. Now you're shipping it direct to the consumer. So you want to be located close to their rooftop. So, you know, that can be anywhere, infill city to suburban, you know, anywhere that there's high density of population, and whether that's for labor force or for your distribution chain, I think that's where you're seeing that trend go.
Yeah, I would just add on that a little bit. You know, the answer is yes. It is moving all over. But, you know, the interesting thing is you've got some new nuances in distribution now. So you got, you know, last mile really, you know, blossoming and growing a lot of roots, which is bringing, you know, new product and renovation to older product in all urban areas, in all infill locations. You're also having, which is really being stressed right now, reverse logistics. And, you know, that is going back out lots of times to close in facilities and facilities that are on the smaller end of the scale, not the big bulk stuff, and the facilities that tend to be the B type product. So you have just a lot of stuff going on. You have the traditional manufacturing that's benefiting from the reshoring and the nearshoring that's occurring, and some cities in the South and Southeast are benefiting tremendously from that. You are having e-commerce boom, which the Midwest is, you know, really benefiting from, and places like Dallas is, you know, beginning to be the new hub of distribution, in my opinion, versus, you know, Southern California. But you're having these spinoffs in these new sectors inside of industrial that don't really get accounted for because 3PL are still running the reverse logistics. So they're considered 3PL, but it's a brand new growth, and it is growing in different locations. So I think the answer is yes. It's kind of growing everywhere.
That's a great point, Alfredo, because I've studied that a little bit too, the reverse logistics aspect. And I always use the joke that, you know, if my wife went to the store and she tried on 10 items and walked out with 2, you know, it didn't really affect anything. Now it's you're ordering 10 items online, trying them all on, keeping 2, and, you know, sending 8 of them back to a warehouse that was never designed to, you know, to restock shelves.
You know, one of the other things that's come along with this push or shift or change is the infrastructure demands at these structures. I mean, if these aren't wired buildings with access to internet, they're getting passed by in my view and what I've seen in Northwest Indiana. So these, you know, while these buildings literally are in the middle of nowhere and they have decent transportation networks, they don't have the fiber infrastructure to really operate like a lot of these major distributors want it to be. And I've seen in most states around the Midwest, a bigger push for the expansion of fiber and technology. And I would say that, you know, concurrent with the opportunities that lie in some of these existing structures in rural locations for distro, I think we're going to see, I'm hopeful, an investment on the public side to their traditional infrastructure, but also to make sure they have the cyber technology necessary to work efficiently at these giant warehouses.
So is there a new approach then, Matt, that people in our industry need to have in mind here as it relates to submitting prospective locations?
You know, here's what I've been looking at, and I'm old enough to remember as long as the building had a sprinkler in it, you were good to go. And that's about what you need. And I think everybody on this call pretty much is. But, you know, some of the demands, at least some of the demands now that come out really have to do with technology, availability of internet access. How do they do their operations? And, you know, those are things that I bake into transactions that I'm working on now. So it becomes part of the entitlement utility discussion. I got water, I got sewer. Do I have fiber? How good is it? Is this a selling point for this particular operation? Does this manufacturer need to have access to high-speed internet or black fiber or dark fiber to make their operations work better? I mean, right now one of the biggest challenges I have at a 2,000 acre, industrial park that was a former military base facility in LaPorte County is that we don't have enough fiber to serve the kind of businesses that want to be in there. Now we have connectivity to 2 Class 1 rails and plenty of land to build whatever we want. So our challenge right now going forward is, as far east as LaPorte County is just that. How do we service this to a level that the current business climate in high-tech manufacturing or higher tech manufacturing or distro want to have to be able to operate?
I think that's a really good point, Matt, is that it's part of your due diligence. It's part of the checklist that you have to make sure is there. Just like the utilities, right? If you're going to do improvements, there's got to be technology available too. So really good point there. Anyone else have anything they'd like to contribute on that topic in particular? Otherwise, we'll move. I want to get a little bit of feedback from y'all as it relates to which are there submarkets, are there regions that are working better than others from an economic standpoint as it relates to commercial real estate development and occupancy?
I'll jump in here. Not to monopolize, but I like to talk, I guess. I would say as we're talking about industrial in general, obviously big box is 70% of the absorption right now, and that's true still in Chicago, and that's why you're seeing the submarkets of I-80, I-57, Joliet really performing well, and you're seeing real rent growth in those markets. But there's still some soft pockets in Chicago, and there's still soft pockets in every market you go to. They may not be attracting the big box, but that's just because that's what's being absorbed, that's what's being demanded, I think that's probably true in a lot of markets. And as long as you got e-commerce growing, which it will grow, I mean, they're projecting another $900 billion of growth in e-commerce over the next 5 years, which will add nationwide in America, which will add close to 300 million square feet of industrial space. It's a big number. But it's not that much larger than the last 5 years that we've had. Last 5 years, we had a little over 250 million square feet of growth in e-commerce, and that translates into the big bulk stuff. So I think as long as you're a big bulk box market or sub-market, you're going to be sitting well for the next few years. And to me, those are the markets that I mentioned in Chicago.
So is it confined to Walmart and Amazon and Target and Home Depot, or is it the 3PLs, the third-party logistics companies that are going to be gobbling up space, or is it both?
It's both. Out of nationwide, and I don't think it's any different in Chicago, 3PLs accounted for about 30% of that absorption. Amazon obviously was a very large part of it. Followed by Walmart and the others. So between those three, as far as total absorption, they probably accounted for 75-80% of the absorption. But 3PLs are an integral part of this. 3PLs are the ones that are bringing the retailers that are reinventing themselves and trying to get competitive on the point and click aspect of it. They're going to the 3PLs. The 3PLs are working, as I mentioned earlier, on the reverse logistics. They're an integral part of this also. So it's not just all Amazon. Amazon's 20-25% of it. It's all the others too.
So this is, can we kind of generalize this as the Amazon effect? Being able to get something in 24 hours or 48 hours?
Clearly, I think so. I mean, probably, the guys that do development probably can elaborate a little bit more on it, because that's where Amazon's going.
Well, even the local companies are getting into this, free delivery within 24 hours, ABT, I mean, how they compete with these multinational, distribution and retail entities, they'll still get it to you in a day for free. So it's, that role, this direct to consumer, new channel that was, perfected in March and April and May, it, certainly benefits logistics companies, because they're all about, economies of scale and cost compression and speed. So they're naturally going to be the beneficiaries of this. I do think that the new layers of logistics companies will emerge to better serve the small and medium-sized customer.
Does the reverse logistics phenomena change the hardcore building, the vertical aspect of industrial warehousing?
Yeah, I think that's hard to say. Obviously the traditional throughput that what Amazon is doing, what Walmart is doing, is changing it. And that's why you're seeing those buildings go taller. They're getting more automation, which allows them to go taller. And their ability to go into locations that may not have the labor. Reverse logistics is not that efficient yet. And I don't know how long it's going to take for them to get efficient, because they don't know what they're getting. They just know they're getting a lot of product. And, where they got to be careful of is it's expensive product. If you're talking about fashion, if you're talking about technology is awfully expensive. Fashion goes out of style quickly. So those are very expensive items to the ultimate producer of it, the retailer of it. If you're just doing, cleaning supplies, toilet paper, those kind of items, those tend to not get returned. And those don't need to be, put on the shelf as quickly. If they are put back on the shelf, they haven't changed. It's just a matter of cleaning them, getting them ready. But it's the stuff that goes out of style quickly or gets outdated, which technology gets outdated very quickly, that are expensive items, and items that, when they're coming back at a 30% return ratio, that's a huge hit to all these companies if they have to pitch it and dispose of it as not sellable.
Yeah.
Hey, how many times have you called a company and said, look, I want to return this? And they say, all right, keep it and we'll credit your account anyway.
Yeah,
They don't
right.
want to touch it.
Right. Furniture companies, for sure. It's happening.
Clothing,
For sure.
that's a growing constituency.
Yeah, really good point. All right, I want to try to, if we can, let's shift to I want to talk about rental rates, vacancy. Dan, if you don't mind, I'd love to get a little prognostication from you on rates and availability of cash and financing, if you don't mind.
Yeah, sure. I think in terms of availability, I think the one thing that I found to be one of the better parts or the better results of COVID were, if I was willing to, put out a deal, and I didn't hear a lot of no's. I heard a lot of people taking their deals because, after deals funded, after the loans closed, I heard a lot of horror stories from my borrowers saying, I've heard a lot of banks or institutions or lenders that are pulling term sheets that are retrading deals. So I think, that customer loyalty, hopefully from my customers, will help pan out in next year and beyond, or this year and beyond. In terms of availability, I think spec is starting to open back up. A lot of people were a little hesitant at spec. I think that's why you saw a lot of statistics now that are coming out. There's a lot more, or there were a lot more build-to-suits in 2020. I think banks, institutions were a little scared of going spec, with uncertainty around COVID. I think it's starting to loosen up a little bit. I know we're starting to get a little more comfortable with that. But I think in terms of rental rates, I'm interested to hear what the rest of the brokers on the panel have to think about rental rates. But I think with a vacancy rate that's sub 4%, and I think there was probably 10 million plus square feet absorbed last year. I think we're going to have some pretty solid rental rates, some rent growth. We're not going to have the spikes in rental rates that you're going to see on the coast. But I think in Chicago and Midwest, a steady increase in rental rates is positive and it's strong for the market. I think it'll keep cap rates low where they're at, and maybe not compress them a lot further, but I think they'll still certainly stay steady, and that's kind of also a good indication of how much liquidity is in the market for industrial right now. Institutional investors want industrial, and oddly enough, I think last year we did I think 2 build-to-sells. Buildings that were pre-sold prior to getting a shovel on the ground. All the developer to do was build it, put a roof on it, and it was sold. So that's essentially a build-to-suit in my book. So it takes a lot of risk out of the deal for us. So industrial is just in favor everywhere, and that will hopefully translate into availability for more spec.
Yeah, I think probably the I-80 corridor is a terrific example of what you're talking about, in particular, Dan. I-80 became a spec development corridor in the last 2 years, Josh?
Yeah, more than that even. There was a couple of those buildings that had sat for over 2 years vacant, and in the last 18 months, you saw about 10 million feet of absorption down there, and it went from everyone being fearful 12 to 18 months that everyone was saying I'd never throw a shovel in the ground down in I-80 in Joliet, to now everyone is trying to do it again. And the interesting thing is there's not many great sites left out there, and so that's what you talk about, the macroeconomics of vacancy rates and rental rates and supply and demand. And vacancy rates, I said it already, absorption outpaced the supply and the new supply in 2020. And so you're seeing these economics of rental rates increased a little bit. You saw both 55 and 80 at the start of 2020 had double-digit vacancy rates. Both of those have dropped down into single digits now. And there still is like I-55 still has a fair amount of vacancy out there, but there's really no land sites left to develop on. So, if you continue to see the absorption rate at the same rate as 2020, which I think you'll continue on that path, if not even stronger, you're going to see some pretty low vacancy rates at the end of 2021, with no room to throw shovels in the ground to, alter that.
Josh, who are the tenants that are going to continue that absorption pace?
I think we kind of touched on some of the major ones. You talk about the Amazon effect. You got the Amazons, some of the e-commerce. I think you're going to see a fair amount of food deals out there. And then, Dan, I think, part of what we haven't necessarily seen the catch up of is all the ancillary guys, the packaging guys, the pallet companies. Alfredo, you talk about reverse logistics. At some point in time, I think somebody's going to start to develop models of, having pure reverse logistics centers. Someone that's sorting them and getting it back on the shelf, faster than anyone else. So I think, also, Tom, I think you mentioned, there's the smaller people. Listen, Amazon in all aspects is kind of a throughput, so you don't have to be warehoused in Amazon's facility to basically be shipping an Amazon product. You could be a small mom and pop shop and have 20,000 square feet of your product and be shipping for Amazon. So I think, Dan, to answer your question, it's, product that maybe historically took up retail shelf space is going to be pushed back into warehouses, which is just increasing that supply factor of warehouse space.
Yeah. It's kind of, 10 or 15 years ago, the distribution companies, Walmart, I think, is the one that blueprinted this model, was that the manufacturers that were making the products, Walmart told them, you get to store that. We don't want that right now. And so I think maybe that's what's going on right now. Tom, you said that you're relocating companies to Wisconsin. Can you want to give us a little overview of what that migration looks like, what you've experienced and what you expect for 2021?
So, if you look at some of the bigger deals that have gone down up there, Silgan Containers leased 525,000 feet. Fresenius Kabi relocated 490,000 feet from Melrose Park, taking a lot of employees north of the border, which structurally is a big deal because companies have been loath to relocate employees in this market because it's so competitive and labor is so tight. I just relocated a medical packaging company, 170,000 feet. They're taking a couple hundred employees north of the border. It's workers' comp, it's real estate taxes, it's being in a state that's fiscally sound. Then it's also, better land, it's an easier place to do business. So,
Technology?
we're seeing manufacturers, packagers, not just 3PLs.
And
Tom,
technology.
Tom, do you see the same issues that Matt sees in Indiana with the fiber access and everything like that?
So now Kenosha County, especially, and Racine County and Milwaukee County, fiber's there. That's not the obstacle, I guess, that it is in Northwest Indiana.
Matt, you have any input on the migration aspect?
A lot of it has to do with the cost of labor and the, these are older companies that I'm entertaining and have entertained that have relocated into Northwest Indiana. We've had over 1 million square feet filled up in 2020 from varying companies, from distribution to manufacturing. We've had interest from, the national markets. We've had vacant facilities that were food processing that have been redeveloped in Westville, 500,000 square feet with, half of that building still being a refrigerated reefer warehouse and two completely different industries, a construction company and Lippert Components going into this building and absorbing, well, Tom, you ought to know, you guys, I think we're involved in that.
Yeah,
So, that's an example of a good deal that was put together. So a lot of it is really being driven by pretty simple math. Either people are tired of the ongoing operational cost of a location and have the willingness to either take on a partner on a real estate transaction, whether it's an investor like Dan's company or it's a municipal deal, to put these transactions together. But I agree with Tom, the central issue has been with all of these companies that what am I going to do about my workforce is usually number one. And number two is how do I divest my asset that I have at the current location? So it seems that, Wisconsin has been doing a lot of the same things that Indiana has, and it's focused on being fiscally responsible and responsive to business and industry. That's not to diminish the efforts that have gone on in Illinois on the 355 and 80 corridor. But if you notice, all those are far away from Cook County, which seems to be the common denominator here.
10 years ago, I would meet with a company and I'd say, look, there are 4 buildings in Northern Lake County and 1 over the border. They say, all right, we'll look at the 4 here, send the maintenance guy to, masquerade the building north of the border. Yeah. Fast forward now, they look at me when I walk in and go, get me the hell out of here.
Yeah, when can I go? So quick anecdote, this is a kind of an anecdotal story, but there's a company in Chicago right now today, and they came into Northwest Indiana and they're looking around. They're like, we want to be in the market. They're in the, the metals business and have a lot to do with the steel industry, and kind of came into town and said, hey, where are all these buildings? I hear about all these vacancies in these urban cores. And I said, you're about 10 years too late. There isn't any. There are no more deals. And anything that you could build, rebuild in, or rehab has been rehabbed. So it kind of circles back to one of my original points is that I think you're going to see a lot of spec development happen. I'm hopeful again that the rates stay low enough where that's attractive and feasible.
So I got a couple other things that I want to try to cover here. And we're going down this road of vacancy rates and your prognostication as to how you see things going from vacancy rates, rental rates. But one other product type that I wanted to touch base on, get your opinions, is fleet facilities. So for example, Amazon did a deal with Bridge in Downers Grove, and they saved, I don't know how many acres they paved to put their trucks on it. And so if they're going to get into this return business, this reverse logistics, is there going to be fleet requirements that's going to change? I mean, I think we've all seen the trailer requirement thing blow up, right, over the last 5 to 10 years. Is this a nuance into the industrial marketplace that people are going to want and need? And are we going to have to anticipate that and provide for it?
You know, Dan, it's funny. I actually financed the Downers Grove project for Bridge, and I was looking forward to phase 2. But I was told, no, there's going to be a phase 2. We're going to pave the entire site and let Amazon park all their trucks there. And you know, so be it. I think, but that's going to be a rare instance. I think, at least in my opinion, you know, you're going to have to find the land and the availability. You know, it's someone who's not going to have the desire to build another building where it could be a 2 or 3 or 4 building park, would just be a 2 building park or a 1 building park with a substantial amount of parking for vans, trucks, whatever the case is. So I think it's going to be all dependent on the site, location, and you know, usually it's going to have to be a tenant that's going to push that on their developer, because I don't think any developer will do that proactively. At least
I think so. Some of the other things that are happening here, and it has to do with, you know, previously utilized, gently used industrial property, if you will. You know, there's always the specter of environmental issues that tend to come up with these site reuse and redevelopment. So, you know, when you talk about parking, distribution, that kind of stuff, you know, there's some pretty challenging spots that are in and around Northwest Indiana and East Chicago that we've seen developers come in and take that swing to redevelop this stuff. And Messer is one of the companies that are coming in. They're trying to do 250,000 square feet, and it's part of a bigger redevelopment area in East Chicago. So you're talking about places that are adjacent to the steel mills and proximity to transportation networks. So I think we're seeing some of that too, that it's having to do with the existing infrastructure that people are using. Pave it, that sounds good. Put a small building or a medium-sized building on it, sounds even better. And I'm seeing a lot of that in Northwest Indiana, particularly in the East Chicago, Gary, Hammond corridor. I mean, I really, there's no developable property in Hammond. I think Lear Seating took the last reasonably viable developable piece out there and did a project. So, you know, again, we're seeing some due diligence in redevelopment. You know, part of the other things that we've done relative to this is redevelop the State Line data center site into a data center, which was a pretty heavy lift on the industrial or the environmental side, but speaks to the demand and kind of the look into the future for having the high speed and being able to do that.
Yeah, I was on that panel, I think, with you, Matt, right? For when they had that that deal out there at that facility.
Yeah, we buildings finished, buildings open. Now we're on to developing the balance of the property with one of the bigger distro companies that's looking for a significant location adjacent to Cook County.
So if we could get your expert prognostication on lease rates and vacancy and what the future holds for us in 2021 from an industrial standpoint, please. Josh, you want to start us off?
Sure. I just want to add a couple points first to the last topic on transportation. You know, a couple of you guys, I think Alfredo said some stuff, Tom, Matt, Dan, you even kind of inputted. But I think you're going to see that need for transportation facilities and more trucking, and it's for a number of reasons. Number one, you know, you're just seeing more and more consumers ship their product to their house. So that's creating a continued truck and distribution channel that wasn't there before. You're seeing the reverse logistics that Alfredo brought up. And, you know, again, then just overall more continued e-commerce, grocery store chains are continuing to ship more and more product direct to your doorstep versus going to the grocery store. So I think the answer is yes. You're going to continue to see that trend. To go into your next point, Dan, yeah, I think you're going to see vacancy rates continue to drop in 2021. I think there's less land available to develop. You've had municipalities become more challenging, frankly, on industrial development, even though that's the need and demand. I think, you're seeing these municipalities kind of push back a little bit on, not developing industrial, in people's backyards because they're concerned about protecting their residents and they don't want, a truck sitting in their backyard. So I think you'll continue to see developers be hungry to try and find sites. I think they'll be creative in, trying to find unique sites that maybe in the past years they wouldn't have developed on. Now they probably would try to because there's no other sites. And I think you're just going to continue to see a wave of absorption that pushes those vacancy rates down.
So Josh, do you think that is absorption, so just a point of clarification, so the cities, are they back to full operation now? Is there still a delay happening with the villages to get permitting and that kind of thing done?
Well, that's, again, I said it earlier, it's every municipality is operating differently.
Right.
Dan Barrins made the point that this, getting done in the city of Chicago can be challenging based on where you're at. But I will tell you, suburban, most of them have gone to a virtual model where they've already been adapted to that. And there's actually a lot less chatter from the community because of that. And it actually causes them, again, as long as they would like to see the project go, they'll speed things up and they'll make it happen for you. But they are becoming very protective of their residents. You're seeing it down in, Joliet and Elwood. Everyone's familiar with the huge headline of North Point with their battle with Joliet and Elwood. You're going to continue to see, headlines like that, maybe not quite as large scale, but, these municipalities are trying to protect their residents so that, you don't have a diesel truck sitting in their backyard while the kids are on the swing set.
Yeah. So velocity, you feel velocity is going to be stronger than 2020?
Yeah, I think, because from about March through September, the example that I use is everyone was driving around with their foot hovering over the brake. They weren't pulling the e-brake or anything. They were just very cautious on, what the future looked like for them. Now I think you've seen that most of these users have realized there's a lot of pent up demand and they need to do something. So I think you're going to see a flood of, demand into 2021 on the industrial sector. And again, that comes from all sectors: packaging, grocery, clothing, e-commerce, everything all combined, I think is really going to thrive in 2021 in our world.
Tom?
So, the 50 to 200,000 square foot tenant was largely dormant in 2020. They're now reemerging now that we're through the election and it looks like the pandemic is going to be solved here in 2021. So that's beneficial. Absorption, I do believe, will be stronger in 2020. I think we're going to see continued rent growth until the time we overheat and then interest rates starts to pop. When interest rates start to pop, that's when things are really going to, that's where we're going to see things slow down.
Barrins, don't raise those interest rates.
Aaron, what is your, can you give us 30 seconds on where you think rates are going?
Yeah, I mean, at least in my world, I don't see rates really spiking anytime soon. I think what I'm hearing and experiencing, I think rates will be flat. I think at least through third quarter of 2021, if not beyond. I think banks are trying to maybe bump a little spread to make up for some the loss in net interest margin from last year. But frankly, I think base rates are going to be pretty tight, and I think as competition heats up for more lenders want to get money out. they're going to have to compress spreads as well. So I think rates will stay pretty palatable for at least the majority of 2021.
Alfredo?
Just to piggyback a little bit on what Dan just said, I tend to believe that rates are probably going to stay low for the short to midterm. And I say that because if you look back at the financial crisis, the Fed did not move the rates for 7 years. And this was a much more drastic impact to unemployment. We still have 8, 9%, 10%, depending on who you read, unemployment right now. So there is, a good 15% of our population out there that are experience financial stress right now. And so the Fed's not going to want to move that. They're not going to want consumer inflation. That doesn't mean we're not going to have inflation. Just like we did from 2009 to 2011, we had asset inflation, which is good for real estate if you're an owner. If you're a buyer, it's not a good thing. And so that is going to occur. And I think, we're going to still have product coming on the ground. I think Chicago had a 6.5%, 7% growth in inventory last year. That's huge for a market that's 250 million square feet. And I think that'll continue on, but just continue on at that kind of percentage is tough to do when you're that large. So I tend to believe that vacancy is probably going to stay flat. We're going to have a lot coming on. We're going to have positive absorption, but it's not going to be a significant delta between the two. So I tend to think vacancy is going to stay somewhat flat, but I do think there's going to be rent inflation, which is good for asset growth. Because if you just have a 2 to 2.5% rent inflation, and your cap rates stay at 4.5, 4.25 for the Amazon type buildings, over a 10-year period, that's huge. You've made a lot of money on the exit of it. So you're not making it on the cash flow, you're making it on the exit. And I think cap rates will stay on the lower end. I don't think, the Feds are going to move rates, so I don't think we're going to have that competition there. And I think rental rates will continue to tick up and the value is going to be created on the exit.
Matt?
I think what comes into play here are things like land cost and interest rates that are going to have an impact on what goes on. As I said, in our submarket, if it's a viable structure, it has somebody in it. The rent rates are stable and increasing. I think if you're an owner, you're in a really good spot, and that's caused it can be a cause for some conflict into the future when you have unrealistic pricings for real estate, especially in the industrial market. And you're trying to put together these transactions, and you're trying to balance the value of the land in conjunction with the build cost that we've talked about earlier seems to be increasing because of the strain on the ability to acquire the industrial material. So, that's an ever increasing cost. So I got an increased land cost and increased construction cost, but I still have that demand that's coming out because there isn't that space available. So, as much as I hate to say it, sometimes the government is there to help you. And things like build, operate, transfer deals and tax increment financing and working with local LEDOs, local economic development organizations to glean these incentives to help our clients certainly fills the gap. Again, standalone deals are going to go forward anyway. There's a project that's getting ready to kick off in Maryville, Indiana that has to do with the national distribution company that doesn't need any help at all. That's going to continue to go forward. It's those mid-range 50 to 60 manufacturing companies that are the backbones of a lot of these jurisdictions that we need to help get across the finish line. That are profitable to the business owner and can be profitable to the company building the spec. So high hopes for 2021. As long as the rates stay good, we can keep land costs where they need to be and construction rates. Looking forward to it.
All right. Kind of a final question here for me is the political aspect. Any long-term impact you think that's going to have on the commercial real estate industry. I was told that if you're in the real estate business, you're also in the political business, so.
Well, not to get too political on it, so I'm going to try to avoid some of that. But I do believe there's a lot of fundamentals that is good for commercial real estate that exist regardless of who won the election. And I think that was going to progress on. There's going to be just nuances. So I think we've mentioned earlier about, manufacturing coming back. I think based upon, who got elected here, that we're going to have a little bit more of that being nearshoring than onshoring for us. So, Mexico is going to be a tremendous benefactor for it. That is going to be a tremendous impact for industrial real estate. So it's not a negative. I think it is a positive. And I think it is a positive for the Midwest and places like Dallas, because with the, I-35 Mexico, Canada agreement that exists right now, that product's coming up and it's got to be distributed out. It's going to land either in Dallas or it's going to land in Chicago for a regional distribution. That's positive for Chicago, it's positive for Dallas, and it's positive for industrial real estate. But like I said, I think commercial real estate was going to trek on no matter who's going to be elected, just because that's what we do. We can deal with good news, we can deal with bad news, we can't deal with no news. And so we just need to know who that's going to be so that we can make decisions.
Yeah, I think there was a significant stall in end of October, right through the election, and I think through the end of the year, actually. So, Dan, do you think there's more regulation going to be involved with your industry, with your business?
Yeah, absolutely. I think Democrats typically have a little more regulation bent to them, and I think we're going to get prepared for that. I think it's something that we're going to have to deal with, over the next, call it at least 4 years. So, in terms of local municipality or local economies, I think we're going to have to, we're advising clients, make sure you're not underestimating your real estate taxes. Obviously in Cook County, that's especially important. But, the banking regulation is certainly something that we're going to have to deal with for the near term.
Anyone else have a comment?
Dan Barrins, you just mentioned one thing that none of us really have talked about yet, and that was real estate taxes. And, it's kind of an, interesting phenomenon that, again, rolling the clock back, a year or two ago, going almost on my same example about Joliet, everyone was, let's get out of Cook County. Anything Cook County, I want to bail on and get out of it. You've now seen the trend of, people going back into Cook County, whether it's from a, speculative development standpoint or purely just a business relocation in Cook County. And I think you're seeing that for a couple of reasons. It's again, the supply chain. You need to be close to the rooftops. If you're a manufacturer, you want you got good labor support in Cook County. You're also seeing, obviously the 6Bs have always been around. So that, creates a real estate tax benefactor that helps get you more in line with Will County. But what I have noticed is, not every municipality, because everyone has a different multiplier, but if you look at, some of the Will County markets, some of them have escalated at a faster rate than Cook County ever has on their real estate taxes. I've seen some properties in I-55 Will County that are, $3 a foot all of a sudden. And so, it's kind of an interesting phenomenon that I don't know if it's, because the real estate taxes have risen at a fast rate in Will County, if that's, cause people not to blink as much going back into Cook County, or if it's, purely the rooftops or labor force, infrastructure. We talked about, Matt, you talked about infrastructure from the fiber and all that kind of fun stuff. So You know, that's something that I think we're going to continue to watch unfold here in 2021 is, you know, the redevelopment plays and people kind of migrating back into Cook County and being less fearful of, you know, the real estate taxes.
Yeah, I mean, I think, Josh, if you're locating in Cook County, particularly, I think, you know, it's last mile or no reason. You should check your understanding of why you're moving back into Cook County if you're not going to be in Chicago or last mile or near in suburbs. You know, the taxes in Cook County, I haven't had a lot of experience with taxes in Will County, and you know, I heard Matt chuckle because I think his next you know, phone calls are going to be to everybody in Will County to move them out to
I'm gonna
Indiana also.
add them to the list. Hey, talking about whether it's nationally or locally, stability helps our industry. And, the more stability we have out of Washington, D.C., the better it is for our business. And certainly stability in taxes and property taxes. I mean, we couldn't make it easier in Indiana. It's 1%, 2%, or 3%. It's it. The value of your building, which is the cost of your building. There's no multipliers. There's no gyrations. There's no 6Bs. There's no nothing. While we have tax abatements, they can be used, but to be honest with you, and when you compare them to places that have radically high property tax rates, it's not even, it's better to use tax increment financing to build infrastructure. So,
Matt, quick question on that. 10, 15 years ago, there was a lot of, TIFs that had gone out that were 10-year TIFs in Indiana that are now coming up on expiration over the next, let's call it 5 years. How do those properties then compete with new development or, someone that does still have significant time left on their TIF?
So functionally what happens in at least my client communities that do it, they either issue more debt to do continued infrastructure or the bonds are paid off. And therefore, if there was a direct investment in the building made with TIF, the owner of the building has received that benefit. So, in general terms, the sooner the TIF is paid off, the better it is for everybody in that scenario. But, one thing I heard about, and I'm hopeful that this is really brought to bear, while I was certainly in favor of corporate tax benefits across the board, it's my understanding that there will be a focus on corporate tax benefits for those companies that actually invest in the United States. I would love to see some rigor into that process. As practitioners on a local level, you mentioned, Josh, 6B. Imagine if we had our arms around that kind of concept on a national level and really put it into practice. I mean, would it be so bothersome if a corporation didn't pay any corporate tax at all and created 200 or 500 jobs as a result of it? Again, those are big items, but again, as long as we have stability and flexibility, I think 2021 is going to be a big year.
Great. Appreciate everybody's input. Anything else that is of top of mind for y'all that you'd like to share? We're coming to the end of our time here.
I think, one last point that I'll make is I think that, you're going to continue to see people, not as much as in the office sector. Office sector is going to continue to kind of migrate on how space plans work and everything like that. But I do think in the industrial sector, you're going to continue to see people try and figure out ways, even after the vaccine comes around. I think they're going to figure out ways of multiple shifts or spacing employees out a little bit more, figuring out some hybrid model of, keeping some employees at home and some in the office. So I don't know, maybe you're going to see a peel back of how much office is built out into industrial spaces. That's a trend that, I'll be curious to watch because I do have clients that talk about, what will their business look like in a year with how their employees interact even after the vaccine comes around.
Yeah, I listened to the office breakout session, and the word that they kept using over and over again as it relates to how they're going to try to re-engineer their office buildings, the word hospitality kept coming up. They want to have it experiential. right? They want to have, people have to feel safe first and foremost. And then they have to feel comfortable in their space. And so the, you know, hospitality was the term that they kept using over and over again. I'm sure, Josh, to your point, I think we're going to see some of that filter down into the manufacturing and the distribution business as well. So I think that's it for us. I really appreciate everybody's participation here. You did a great job. Todd, thank you for having put this committee, this group together. I think it worked really well for us. So thanks very much.
Thanks,
Amen.
Todd.
Fantastic day. Way to take us out. Alfredo, really good to see you. Best
See you.
industrial guy I know. Thanks, everybody. Have a wonderful afternoon. Have a wonderful weekend. Enjoy the cold Chicago. I'm cold Minnesota. Let's just get through COVID. And isn't it nice to be in industrial, though? You can wear
Yeah.
a purple coat and still be the
Yeah.
popular kids now. It's really cool.
Todd, thanks for putting it together, man. This is awesome.
Yes. Fantastic.
Really simple. Thanks.
Likewise. Thanks to you all, too.
All right.
Thanks.
Appreciate
Thanks,
everybody.
everybody.
Thank you.
Alfredo, good to meet you. Darren, good to meet you. Matt, good to see you again.
Thank
Dan,
you.
nice to meet you.
All right.